South Korea has put the brakes on the short selling of stocks from this Monday. This measure is most likely to last until June of next year, and watchers are now keeping a close eye on how this temporary ban could shape the market. For more, I have our economics correspondent Shin Ha-young joining me in the studio. Welcome, Ha-young.
Great to be here, Ye-eun.
Now, Ha-young, I'd like to dive into the first question. What exactly is short selling?
Well, short selling is when investors trade with borrowed shares, and they do that in the hope that the price will fall later so they can buy back at a lower price and pocket the difference. For instance, if a stock valued at $100 per share is expected to decline, an investor can borrow the stock, sell it, and then repurchase it when the price drops to $60, making a $40 profit. And it's a very accepted and often useful tool for investors to make money, and also for the market in terms of correction when the stock market or even individual stock prices are overvalued. It's a very accepted and often useful tool for investors to make money, and also for the market in terms of correction when the stock market and even individual stock prices are overvalued.
Ha-young, this is the fourth time financial regulators have banned short selling stocks here in Korea. And referring to the circumstances in the past, what usually prompts the government or officials to do this? And what was different this time around?
Well, regarding the recent ban, the Financial Services Commission cited illegal short selling activities by global investment banks amid growing uncertainties such as the Israel-Hamas war.
Amid global turmoil, we discovered illegal naked short selling by global investment banks and circumstances of additional illegal activities. It's a grave situation where illegal short selling undermines fair pricing of stocks and hurts market confidence.
In fact, this is the fourth time that it's been prohibited. The first ban was back in 2008 during the global financial crisis, the second in 2011 during the European debt crisis, and the third during the COVID-19 pandemic. But this time, it's different from the previous cases. It was clear that in the past three cases, short selling was banned amid a sharp decline in stock prices. But the latest measure is aimed at institutional improvements rather than in response to a stock market crash.
Then how did the temporary ban affect the stock market, particularly this week?
Well, the very first day of trading after the announcement showed the country's benchmark Kospi Composite Index surging to its largest one-day rise in over 3 years. It rose by 5.66%, and the tech-heavy Kosdaq increased by over 7%. And the gain was especially prominent in technology stocks with secondary battery shares of EcoPro BM and EcoPro. And the rise seen on Monday was also largely led by foreign investors. And this surge led to the activation of the Kosdaq sidecar limit, which mitigates volatility in stock markets and comes into play when the Kosdaq 150 futures fluctuate by more than 6% compared to the previous close. And this, however, didn't last. Over the next few days, stocks saw a consecutive decline as foreign investors turned into net sellers. The sidecar limit was activated once again on Tuesday, but for the exact opposite reason from the day before, to mitigate a drop. While the Kosdaq closed down again on Thursday, the Kospi rose by 0.23%. And while some analysts say that this volatility is a result of foreign investors leaving the market, others say that it's more about the psychological effects of the ban on individual investors. Take a listen.
I think the market rise in the first day was more psychological than real because so many individual investors had negative feelings about the market from the short selling. So we saw a very high increase on the first day. And as perhaps investors looked at a longer run picture more reasonably, they decided that the prices are probably going to resettle to a lower level. So that's why we saw the prices fall on the second day.
Ha-young, as you mentioned, we've seen fluctuations in the stock market, namely from foreign investors taking a different stance. And I think it has to do with banning short selling of stocks is quite unique in a local practice here in Korea. And I think that could affect how foreign investors actually commit to the market, right? So why don't you now analyze how global markets have been reacting since Monday's measure?
Well, according to Bloomberg, some observers say the complete ban makes the Korean market less transparent, and therefore therefore less attractive. The report added that the restriction may hinder Korea's chances of moving from an emerging market to a developed market. And Reuters also cited the uncertainty over short-selling regulation as one of the factors that need to be resolved for Morgan Stanley Capital International to upgrade South Korea's status. There are projections that it may be difficult to expect a boost in stock prices as short-selling accounts for a tiny portion of the nation's stock market. And regarding the recent ban, Seoul's Finance Minister Chu Kyung-ho said that it was a necessary measure for now and added that the government will continue with reform measures to win developed market status.
I see. And as an economics correspondent, I think you can answer this million-dollar question. What can we be looking forward to now from the market then?
Well, the truth is this ban is temporary, and the government is using this period to make improvements to the short-selling system. In particular, it addressed the need to level the playing field between domestic retail investors and institutional and foreign investors. One expert points out the disadvantages individuals currently face in the stock market. Take a listen.
The reason that current short-selling system in Korea may be disadvantageous to individual investors is that, for one thing, the institutional investors, both domestic and foreign, can borrow stocks for an extended period of time, but individual investors are limited to how much time they can borrow the stocks to engage in short-selling.
Meanwhile, there are concerns about the potential consequences of this unusual situation on the market in the future. The domestic short-selling market is dominated largely by foreign investors, and as a result, it's likely to impact foreign investment in South Korean stocks. Take a listen.
There's a possibility that as institutions and foreign investors are unable to short sell, they also won't be able to keep up the same proportion of going long and therefore damage the soundness of the financial market.
Some experts believe that sparked by the recent ban, the momentum of short covering or buying back the borrowed shares in order to return them to the lender may have been exhausted.
I guess we'll have to see how it plays out throughout the week, and you'll be covering it as our economics correspondent. Thank you so much for joining us today.
My pleasure.